Solutions series, the online briefing program that comes to you live every 2 weeks with positive strategies and practical today's program. This informative session will examine the quantitative and qualitative factors and the challenges and realities for evaluating a deal if you can find them. Steve Martin is Managing Principal. Welcome back to the NAIOP Solutions series, the online briefing program that comes to you live every 2 weeks with positive strategies and practical tactics to help you succeed. My name is Bennett Gray, and I'm your host today. In today's program, Steve Martin will examine how you evaluate a deal in today's changing environment. This informative session will examine the quantitative and qualitative factors and the challenges and realities for evaluating a deal if you can find one. Steve is Managing Principal with SDM Partners. He is a 26-year veteran of commercial real estate whose areas of expertise include acquisitions, development, and finance. Steve, welcome and thanks for being with us today.
Thank you, Bennett. I appreciate it, and I appreciate everyone joining us. Good afternoon. As we get started here, the first thing I'd like to point out is, I heard someone say this at a presentation one time, and I think it's appropriate. My job is to speak. Your job is to listen. If you get finished before I do, I understand. I also think that I need to explain my bias. You know, I am an investor, a buyer. And I'm having some trouble with the PowerPoint. It's not forwarding.
Click on the screen, Steve.
Okay, there we go. Okay, there we go. Sorry. As I said, my bias is I'm an investor, I'm a buyer. So my comments and perspective is going to be, you know, obviously tilted in that direction. The evaluation topics we're going to go through and things we're going to focus on are quantitative, i.e. the math, qualitative type of things, the environment or the economy. In simple terms, look, as an industry, we've overcapitalized, we've over-leveraged, and we've overpaid. We're going to have to take our medicine. I'm actually going to fast forward to the answer, or the last page of the book, if you will, and give you the answer. I mean, the math, as I'll show, is pretty straightforward. The environment is tough, and I actually think it will only get tougher. The real challenge or the problem is really human nature and people and dealing with what we're going through. You'll find as I go through this, you know, and if you know me, you know, occasionally I probably am wrong, but I'm never in doubt. First thing I want to look at and speak to is just the timeline, if you will, or the process that I see us going through in the next coming years as we work our way through this. 2009 is probably already done. There may be a handful of deals that get done as the year closes out, but more than likely, if you don't have a deal in the oven, so to speak, by now, it's not going to get done. 2010, hopefully, you know, 6 months into next year, deals start coming loose, breaking loose, people selling at values that seem attractive to capital. I hope that I'm off at least 6 months here, but I can see next year, you know, continued decline. We're just getting started. The worst is yet to come. I still think that, you know, there'll be some missteps here, and I would advise patience. Then we will go into a buying scenario. I mean, there'll be some early deals done here that will be just great deals. And actually, I think the art of the coming period is going early to make, you know, the huge profits. But just because you go early doesn't mean that you're right. Obviously, you need to be right. I think capital will flow back in. There is still a lot of equity out there, I think, not as much as there was, but when things get priced, as the money sees fit, the money will flow back in. You know, I think some of the costs, the opportunity cost of people with legacy issues or problem transactions will be a huge cost for some people out there that won't be able to take advantage of this buying opportunity that is we're on the forefront of. In a lot of ways, I do think that we are going to be somewhat like the early 90s. I think you've got to be careful when you compare these periods because they're never exactly the same. Obviously, in today's environment, the downturn is much more pervasive than just real estate, which was the case, I think, in the early 90s. Then after you've bought it, that's just the starting part. I think then you've got to create value. You've got to execute a business plan. You've got to lease up the asset. You're probably going to have to rehab the asset. At some point in that cycle, you will probably refinance the asset, return some of the equity, put cheaper capital into the mix, and return some of your equity to your investors. And I think credit will, at this point, hopefully have flown back into the marketplace. Then if you still are holding on to the asset, you will probably keep it for a few more years, but ultimately sell it because at this point you've made your money, and if you're managing to a return, the return's only going to go down the longer you hold it. So to maximize your return to your investors, you're going to sell at this point. And as I talk to people in the industry, I'm finding that this term new normal seems to be more and more pervasive and almost becoming trite. But I do think that as we come out of this, there is some new normal that is not where we came from. And as I was explaining some of this to an investor of mine, as we were looking at a deal here in my marketplace in Atlanta, we were reviewing the market statistics, and he said to me, he said, Steve, this isn't good, is it? I said, well, it's actually very, very bad. This is not going to be for the faint of heart, certainly investing early on. Some quantitative comments. Look, the methodology has not changed. I mean, everyone is still going to use Argus and discounted cash flows. What really has changed are the inputs and the attitudes that go along with the assumptions in that model. And a logical question is, how did we get here? It's just chasing dollars. I mean, you had a perpetually positively sloped line or an income stream that never went down. Well, obviously, a lot of us misstep, myself included, on some of these, and the values are down. I mean, and this is what we're all trying to get to: is what is the value? What is the number? That is the major quantitative question. Problem is no one knows, or certainly they cannot agree. I would submit to you that our industry was much more driven value-wise by flow of capital into our business as opposed to just inherent demand for our product, i.e. people wanting to lease it. And there's a swath of value that has been wiped out and is not coming back and is somewhat analogous, I think, to changing of the tax laws in 1986. I mean, the fact of the matter is, whatever the value is, it is down, and in a lot of cases, I think, considerably. Some things we're going to touch on quantitatively is cost of capital, cap rates, yields, some key underwriting assumptions. Then we'll also take a look at a hypothetical office building and track it through some of the ups and downs that people are going through. One of the challenges or problems that all of us are having, I think, right now is there's so few deals on the marketplace in the market that do not meet the expectations of capital. Consequently, nothing's trading. And we're all guessing at what the values are based on our biases, our motives, or our perspectives. Weighted average cost of capital. This is, some people would probably consider this a corporate finance type of thing, but I think it is relevant to real estate. Where we were 3, 4, 5 years ago, or traditionally, was 75% debt, 25% equity. I've chosen interest rate and returns here, 5% for the debt. Actually, you can probably make a case that it's lower than that. I'm sure a lot of deals that were done, 05, 06, certainly if they were bank floating rate deals, were LIBOR plus 150 or something like that. Well, 30-day LIBOR right now is about 25, so that puts that interest rate at 1.75%. A lot of deals can tread water when you have that cheap of money on it. the reality of that's going to be is when that loan matures, if they're able to keep it in place, I mean, that loan will have a floor interest rate set probably about 5%. So you've got almost a doubling, maybe even a tripling of the cost of the money that someone has on a deal. And I'll share with you a comment that an old banker, credit officer said to me one night at dinner many years ago. He called LIBOR the cocaine of banking or finance. And I think you got to be careful when you start thinking that, LIBOR plus 150, is your cost of capital. And also the other thing I would say about the debt is back then, that was non-recourse debt, and it was also interest-only debt. Today, we're at 50-50 debt and equity. You have increased interest rates on that money or costs or expectations. I chose 7% for the debt. I could probably make a case that it's even higher than that. Certainly if it's a permanent loan. If you had a interest rate of 7.5% with a 25-year amortization, that's an 8.9 constant. Equity, I think, most of the investors I talk to and people I'm involved with, 20 is a good workable number. And the point that I'm making here is that you've got almost a doubling in your weighted average cost of capital from 7.25 to 13.5. And I'll also point out that the debt today is going to have amortization in it. You might be able to get a little bit of interest on it, but it is going to amortize probably on a 25-year schedule, and more than likely, certainly if it's bank, you're probably going to have to guarantee that debt. Another concept that we'll look at here is just yield on cost and an exit cap. I think a lot of people probably apply this to development deals. I also like to apply this to an acquisition deal because certainly acquisition deals today that have a lot of hair on them, have a lot of work, a lot of money to be put in them, that is no different than a development deal. You're just getting in the process at a different point. A safe deal back in 2005, 2006, you may have developed or bought that deal at an 8 yield on cost, assuming you're going to exit it at a 6. That was your spread, the money or the profit you were going to make. Today, I think those have moved up, at least 200 basis points. All of these concepts, we can debate the magnitude, I think, but I think the logic of it, most everyone would agree with. A lot of the deals I find myself looking at that are opportunistic deals are probably in this lower right-hand box, developing, buying, certainly no development, acquiring an asset on a 12, thinking I'm going to exit it at a 10. It might slide down, 100 basis points from there. And I think this is the crux of, in essence, making money when you're buying things, is that spread that you're talking about. And I've always made a differentiation between being in the money business versus being in a real estate business. We've come through a period where a lot of investors, I would submit to you, were much more in the money business, which was putting money out to collect a yield on it, whereas the real estate business is much more about investing capital to create wealth, and incorporates the concept of not only return on but return of. The conclusion is, I think pretty clear. With the cost of capital and returns both increased, by definition, those values have to go down. And I think as an investor, you have to be mindful of doing deals that not just work, i.e. cover the cost of capital, but doing ones that you actually know that you've made money, the day you bought it. Because in the acquisitions business, I think the philosophy should be you make your money when you buy it, you just get it when you sell it. Some of the key underwriting assumptions that I chose to focus on, and look, there's no revelations here, but clearly people have trouble coming to grasp with when you factor all the assumptions into a model, what that does to the value. Stabilized occupancy, clearly they're lower. The days of stabilizing a deal at 95, 97%, that's not where we're at. It's going to much more mirror the submarket that the property's in, which will probably put it, mid to high 80s, maybe into the low 90s. Lease up, clearly going to be longer. If you bought, let's say at the extreme, an empty building, 3 or 4 years ago, you would probably assume that we're going to lease that building up over 2 years. Today, it's probably more like 3 or 4 years. And I would also submit to you that you probably appropriately would have, on the front end, a period of no leasing done, just because I think it's early, and I think in a lot of markets, you can really question how much demand there is at any price. Rental rates, again, they're down, they're declining, and then once they do bottom out, I think they will be flat for a period of time, and then once you do start growing them, in the model, you will grow them slower. I mean, I do think that there's a point in time when we will all, to be competitive, will start spiking our rents, but I don't think we're at that now. You're also going to incorporate free rent into that income stream. Tenant improvements. I know here in Atlanta that is one that is pretty scary for us, because as I look at different deals in my marketplace, those have gone up significantly. And I'd also point out, don't confuse what the tenant may actually spend on the TI versus money that they'll use to go towards rent, because they're really trading off, the face rate, the free rent, and the TI to come up with a net cost to them. Exit cap, I think easily, across the board in a lot of product types, they're up at least 200 basis points. Debt and equity, as we talked earlier on our weighted average cost of capital, we've gone to where we can use much less debt. And I would also point out that these are off the lender values, not buyer's values. You actually get a double whammy here of, a lower relative percentage of debt, but also off a lower value. Target returns, as we talked in a previous slide, those are increased. I think on levered, 50, 60% leverage, the lowest I think anyone I know would accept would probably be 18. I think in most cases it's going to be 20 at least, if not higher. Again, the result of the conclusion here is with all of these assumptions going against the deal, the effect is exponentially negative on value. I mean, look, value is no more than the sum of expectations tempered by, one's assessment of risk. Here's our hypothetical office building. All I did was take a 200,000 square foot replacement cost building that is just a $20 triple net rent on an 8 cap. $20 rent, that's the $4 million NOI. Let's say we bought that building in 2006 on a 6 cap rate. So we paid almost $67 million for that building, $333 a foot. We put 75% debt on it, so you got $50 million there, 6% interest only, 5-year term. It covers 1.3 times. Most lenders would think that was fine, certainly during that time period, and we've got almost $17 million of equity in that deal. Let's fast forward to today, and we make one change. We change the cap rate. We go from a 6 cap rate to an 8 cap rate. All of a sudden, the value of the building is worth $50 million. The equity has been wiped out just based on that one change. Let's take that a step further. If we had a hypothetical tenant in our hypothetical building or multiple tenants, I know a lot of what I see going on is renegotiating of rental rates in buildings. Let's say that the tenant or tenants in that building renegotiated their rate down to $15. All of a sudden our NOI is down. We've already said our cap rate moves to 8. Now our building is worth $37.5 million. Now not only is the equity gone, now the loan is impaired by $12.5 million. The good news is, I guess, it's still covering, debt service one time, so it has no margin for error, and we've got a 44% decline in our building based on those two changes. And I've seen this in our marketplace. I guess the gift keeps on giving, if you will. Let's say that the tenant in that building goes bankrupt. Now all of a sudden you've got an empty building. You paid almost $67 million for it. Now it's empty. The rental rate that I chose here of $13 is intended to impute, also the costs of downtime, TI, commissions, and I'll refer back to the yield on cost chart that I was using and say, the risk that you probably have with this 200,000 square foot building is probably in a market that has 15 to 20% vacancy, if declining fundamentals. So if you take our rental rate and our NOI and cap that at 12, you've got a building that's worth about $22 million. The loan will be in default. This will not be an instantaneous scenario. It'll take, 6 to 12 months to play out with the owner at that time and that lender. But, the bottom line is you've got a building that's declined in value of 68%. Let's fast forward to the future now. If somebody bought that building for the $22 million, they leased it up at the rental rate of $17, and they sold it at $10, building now worth $34 million, and that investor has, made $12 million. We can debate the magnitude of how these changes have come about, but I think, we're all seeing this play out in our marketplaces. Qualitatively, the psyche that we have going on out there, I think clearly buyers want a great deal. I mean, at the extreme as a buyer, I think you want, the best real estate at the lowest basis with the cheapest capital. It's never that good, but that's, kind of what you're striving to have. You want higher returns. You want the stress. You want it to be lender-owned, not because you're wishing bad on anybody so much as you want it in the hands of somebody that can actually make a decision as what it's actually worth and can sell it for that. Sellers, I think anybody that is probably in the marketplace as a seller today is doing that out of necessity, not because they want to, given what values are. They're waiting, they're hoping. I'm sorry, but I don't think there is a tooth fairy out there. They are chasing it downhill. I've seen it time and again. They come to market, they want 100 for it. The values come in at 80. They say no. They come back 6 months, 12 months later, and you say, okay, I'll take 80. No, it's gone down. And I think that will continue to play out. Again, psychologically, the issue here is human nature. That's, I think, the biggest challenge of the marketplace. I mean, people, going through the range of emotions from denial, anger, blame. It just takes time to work through that. So, stay patient. What I think we want is investors to go on is sellers or lenders making balance sheet or accounting decisions versus real estate decisions for two reasons. One, if they're making a balance sheet or an accounting decision, they're getting something positive out of it from that. Secondly, if they're looking at the real estate decision, they won't like that. But more importantly, what you've got going on here, if they're getting something out of it and the buyer's getting something out of it, that's a win-win, and that will cause transactions to take place. Actions, qualitatively, clearly we need some capitulation, plain and simple. When it will come, that's the big question. I make a statement here of buying good real estate. I mean, this is ultimately what will save you. I think you have to be careful of just because you can buy it cheap doesn't mean you should own it. And I'm one that used to say no bad real estate, just bad prices. I mean, I've looked at some things that, literally you cannot give me. So you have to be careful. Again, as I said previously, buying it right is just the first step. Subsequently to that, you also have to be able to create value and execute a business plan. You've got the basic appraisal methods in play. If you looked at a cost appraisal, cost at this point is irrelevant. Under today's economics, you wouldn't build, any of these buildings. There are no comparables. Nothing's trading. Comparables from the past are just data points. They're not relevant. Right now, we're all just grappling, as on the income approach is what is appropriate. One comment that I would make is that I don't think, we went from an environment where buyers were having to pay for the perceived upside. The environment we're going into, buyers are not going to pay for upside. They're going to look at the future a lot flatter than they have in the past. Environment-wise, obviously we've come through and are going through a major recession, huge job losses, which certainly for the office business is a big issue. And I don't think that, we'll start having a recovery in real estate till we start adding jobs back. Commercial real estate is lagging the overall economy. I would submit to you that we're just getting started with our downturn. All the things that we've been reading about for the past year and a half are just now starting to work through our business. Consequently, the question, it begs the question, are we at the bottom yet? I don't think so. There's a lot of unknowns. I mean, one of which a lot of people debate and talk about is, what does the recovery look like? Is it a V shape, a U shape, or is it a double dip? Start back up, drop down. So I think you need to be careful and mindful of those dynamics. The government and the banks are prolonging the logjam. The government doesn't want the shocks to the banking system of them selling assets at what it would take to clear the market, because I don't know that the capital of these banks could take that. So they're enabling this to play itself out and let the banks, earn enough capital to where they can afford to take these hits. Real estate market and fundamentals. I've focused mostly on the math of the marketplace, if you will, the finance. Clearly, though, you have to know the market or the sub-market that your real estate is in. I think in most cases you're going to find deteriorating fundamentals, vacancy, rents going down, more sublet space. As I've gone through this year, the deals that by and large that have come out have been the lower quality deals, and I think it's logical that as we head off into this that you would see the weaker deals first. I mean, if you're coming up on a pack of runners, you're going to catch the slower ones first. So just be patient. I would also advise you to be aware or be conscious of the new basis or the to-be new bases of buildings that will trade around your buildings, because that is what the competitive basis will be set off of, what people will be computing returns on. So you have to be mindful of that. I would also predict that in each of our markets, there will be a deal done that will cause people to say, and I've got dang in here. Actually, I would say the word is probably damn it, because you're going to look at it and you say, that was a great deal. And all of a sudden, people are going to panic in a sense, and their attitudes are going to change, and they don't want to be left behind. They say, it's starting, and the attitudes will change, and people will start being more aggressive. Capital and deals, risk and reward are out of sync. We're searching for a balance. That's that pricing mechanism going on out there. Capital is clearly very cautious. I think there's ample equity that will be in the marketplace once the returns and the pricing gets where that money wants to move. Debt is limited. There will be more seller financing that will be more common as we go forward to provide liquidity to the marketplace. In my opinion, private capital will lead us out. Institutions typically are followers and are more risk averse. And I would also comment to you that whatever you think is a good value is not cheap enough. I've looked at any number of deals that when I go into it and what the owner or the broker has said to me is the guidance number, intuitively I may say, that doesn't sound that bad, but I'm also looking backwards. When I load it up, put in today's assumptions, the value that comes out the other side, consistently is just never cheap enough. And I assure you, I want to, I think as a buyer, you want to buy it as inexpensively as possible, but I would take the converse of that and say, as a buyer, I also want to be able to pay as much as possible so I can be competitive, and those things are pulling at each other. A couple of sayings that I have that I wanted to share with you. The developer's creed comes from when I started my career back in the early to mid-'80s with Mellon Bank. The guy that was my boss's boss said this to me one day. He says, a dollar borrowed is a dollar gained, a dollar refinanced is a dollar earned, a dollar paid back is gone forever. And that's always kind of stuck with me. This next one here, sometimes the equity is in the debt. A broker friend of mine said that to me here a few weeks ago, and that just stuck with me. And I think there's a lot of hidden meaning, unfortunately, in this, is that the equity is in the debt, because the lenders are going to wind up owning a lot of these. Where are we at? Those of you who do know me, I tend to think and communicate in metaphors or analogies. The point we're at right now is no different than two people crossing the desert in a car, and they've only got a quarter of a tank of gas, and they know there's not a gas station. Now, do those two people stop and shoot each other right now? No. They drive till they run out of gas, and that's where we're at. And there's, those people may even get out and walk in a while, and every now and then a car will come along, but in most cases, I don't think that car is coming. And then we've all heard the old adage, a rising tide lifts all boats. The corollary, or the other side of that, is you don't know who's swimming naked till the tide goes out. Well, the tide is going out, and it's not a pretty picture. Now, in closing, quantitatively, I think we talked about the math is real simple. That's not real hard, and the values are down. That's kind of a duh. Qualitatively, I mean, what we're dealing with and the biggest challenge we have is human nature and people just coming to the realization of what has happened to them. And then the environment is tough. but I actually think that the worst is yet to come. Look, I'm not trying to be negative. I just base that on what I've read for the past year, what I see, and like I said, I don't wish bad on anybody. In closing, though, I do think there's a silver lining. The acquisition opportunities before us only come along every 15, 20 years. Some people have said to me, Steve, it's not, what we're in right now doesn't even come along every 20 or 30 years. So my point is, I think there's going to be a lot of money made. Just be patient. It's coming. I'll close with a quote from Jeff Kemp, the NFL quarterback. His father was an NFL quarterback. Jeff spoke at a breakfast here in Atlanta back in February, and he defined vision as seeing what is not clear before others even begin to see it. So with that, good luck, happy hunting, and I thank everybody for joining us today. You'll see my email address here. I'll leave it to you whether or not this was an excellent presentation. I enjoyed preparing for it, and I welcome any questions or comments. If you agree, disagree, or have any questions, I welcome those. And hopefully we'll see a lot of you at the NAIOP National Conference in Chicago here in a few weeks. And with that, I will turn it back over to Bennett.
Steve, on behalf of NAIOP and our audience, I want to thank you for sharing those insights on evaluating a deal today. For those of you who want to hear this presentation again, it will be available by close of business today, along with all the past Solution Series programs on the NAIOP corporate website at www.naiop.org. Click on the large button on the front page that says Solution Series. For the next Solution Series program, which will air on October 21st, you will receive an email from NAIOP Corporate with details about the topic and presenter. As you know, the Solution Series is designed to provide you with some new ideas and instant takeaway value. But some topics require a more in-depth discussion, and for that, NAIOP offers 90-minute full webinars. The next full webinar takes place on Thursday, October 29th. This webinar will examine energy usage in the U.S. and demonstrate how the use of metal roofs and walls can greatly reduce energy consumption in buildings. In response to your requests, the cost of webinars has been dropped and is now $65 for NAIOP members and $95 for non-members. To register for this full webinar, just go online to naiop.org/webinars. Thank you for attending our session today, and please let us know what topics and presenters you would like to hear from in future programs. We encourage you to be part of the solution. Goodbye for now.